Hello and welcome, my dear friends and fellow companions on this journey. I am thrilled to have you here with me for another key and critical lesson. Today, we are embarking on a journey that is the ultimate destination for every trader. A journey to find the holy grail of trading. Quote, when we all enter this world, we search for that one perfect strategy, that one magical formula or secret indicator that always works and never loses. We scour the internet, books, and various courses looking for this hidden treasure. But I am here today to reveal the biggest secret of this market to you. Such a thing does not exist. The Holy Grail is not a ready-made strategy that you find. The Holy Grail is a personalized system that you build with your own two hands. Today is the day that we transform from being mere followers into being the architects of our own success.
The word strategy might sound grand and intimidating, but in reality, every powerful trading strategy is built upon just three simple, sturdy pillars. If any one of these pillars is missing, the entire structure of your strategy will collapse. Pillar 1, the entry trigger. This is the precise answer to the question, what specific event must happen on the chart for me to press the buy or sell button? This trigger could be a bounce off a pivot level, a break of structure, a MACD crossover, or any other signal. Pillar 2, risk management. This is the answer to the question, if my analysis is wrong, how do I protect my capital? The exact location of your stop loss and your position size are defined in this pillar. Pillar 3, the exit plan. This is the answer to the question, when and how do I exit the trade for both winning and losing scenarios? A strategy without these three pillars is just a raw idea and a dangerous gamble.
Now we arrive at the most important and emotional part of this whole affair. Let's assume I present to you the best strategy in the world, one that has been profitable for me on a golden platter. Would this strategy be just as successful for you? Most likely no. Why? Because the most crucial element in a strategy's success is its harmony with your own personality and psychology. A trading strategy is like a race car or an expensive suit. It must be perfectly tailored and fitted to your specific characteristics. Are you a patient person who can wait for days for a single trade? Or do you have an energetic personality and need the fast pace of short-term trades? Can you handle the psychological pressure of a low win rate but high reward system? These are questions that no one but you can answer.
So how do we build this personal strategy? We must act like a professional chef. All the tools and concepts we have learned so far, from market structure analysis and pivot points to indicators like MACD and moving averages, are the raw ingredients in our trading kitchen. A strategy is your own special recipe. You can combine different ingredients to achieve a unique flavor. For example, your recipe could be main ingredient, price reaches a confluence zone of a weekly and daily pivot. Seasoning, getting a fractal confirmation on the 15-minute time frame. Cooking instructions, entering the trade only if the reward to risk ratio is at least 3-to-1, and managing the trade based on the subsequent pivot levels. By combining these ingredients, you create a system that is completely personal and in sync with your own perspective.
My goal in this lesson is not to give you a fish. My goal is to teach you how to fish. In this lesson, we will review a few strategy templates or blueprints together. For example, a simple trend following strategy and a reversal strategy. Consider these as starting points. We will learn together how you can take these initial templates and by adding or removing ingredients, different tools, personalize them for yourself. Finally, we will talk about the importance of testing and journaling, because a strategy only truly becomes yours when you have tested it on historical market data and have developed faith in its results. By the end of this lesson, you will have a clear mental framework for building, testing, and optimizing a trading strategy that will be uniquely and profitably yours.
Today we are moving beyond the world of learning theoretical concepts and are stepping into the world of creation and construction. We are going to write a trading strategy for ourselves. But before we begin, we must understand the difference between a strategy and a plan. A strategy is confined to our technical rules for entering and exiting a trade. It is the precise answer to questions like, where do I buy, where do I sell, and where is my stop loss? A trading plan, however, is something much, much larger and more comprehensive. The plan encompasses your entire business as a trader, from risk management and psychology to your daily routine and long-term goals. In this lesson, we will focus on building the beating heart of your trading plan, the technical strategy itself. We will learn how to use all our knowledge to design a personal money-making machine.
Every strong building has a solid foundation, and the foundation of every trading strategy is market structure analysis. Before doing anything else, you must decide for yourself how you will read the primary trend of the market. Are we in an uptrend, a downtrend, or a range? More importantly, how do you personally define a break of structure, BOS? There are different approaches to this. An aggressive approach says that as soon as the price breaks its most recent swing high or low, we have a break of structure. This approach gives us faster signals, but may also have more errors. A conservative approach requires more confirmation before declaring a break. As the first step in building your strategy, you must be honest with yourself and choose which philosophy is more compatible with your trading personality. This choice will guide all your subsequent decisions.
After we've determined the overall direction of the market, we must find our, quote, hunting grounds. These areas are our supply and demand zones. But are all supply and demand zones worth trading? Absolutely not. This is where you make the second crucial decision in building your personal strategy. You must define a set of filtering rules for yourself to ensure you only work with, quote unquote, high probability supply and demand zones. There are several options before you. For example, you can decide, quote, I will only trade zones that have caused a break of structure and have a clear imbalance, quote, IFC. Or you might say, quote, I will only focus on the origin of major moves, the extreme zones, and will ignore the zones in between. These rules act like a powerful filter, removing low-value zones from your list and keeping your focus only on the best opportunities.
An advanced trading strategy is not limited to just structure and S&D zones. It also considers liquidity, the very fuel that makes the market move. Liquidity is where a large volume of stop loss or entry orders have accumulated, and large market makers move the price in that direction to activate these orders. As the third pillar of your strategy, you must define your perspective on liquidity. Will your strategy be based on anticipating a liquidity sweep? For example, will you wait for the price to take out the previous day's high or low and then enter in the opposite direction? Or will you focus on the liquidity resting below major trend lines and wait for them to be broken. Having a specific plan for analyzing liquidity will give you a deeper and more professional insight into future price movements.
So far, we have identified the trend, found our hunting zone, and analyzed the liquidity. Now we arrive at the most critical moment, the moment we pull the trigger. You must define a completely specific and mechanical entry method for yourself. Here too, there are different options with varying risk levels. One method is the risk entry, where you enter the trade as soon as the price touches your zone for the first time, trusting in the strength of your zone. This method gives you a smaller stop loss but carries more risk. Another method is the confirmation entry, where you wait for the price after entering your zone to create a small change of structure in your favor on a lower time frame before you enter. This method has lower risk but may sometimes cause you to miss the trade. The choice between these two depends entirely on your personal risk tolerance.
Now that we are familiar with all these pillars and their various options, how do we turn them into a codified strategy? My advice to you is this: get a notebook and a pen and write down every concept and tool that you find interesting and practical. List all the different options for analyzing structure, zones, liquidity, and entries. Then go to the historical market data and test each of these options individually. See which method of defining a break of structure feels more comfortable to you. See which type of supply and demand zone you are better at identifying. This process of note-taking and testing helps you to select from among dozens of different tools and concepts the ones that truly work for you and that you feel comfortable with. This is the first step in building a personal system.
Finally, after you've tested all the options and have found your favorite puzzle pieces, it is time to write your final, quote, strategy document. This document is your trading Bible. You must clearly and without any ambiguity write down your rules within it. For example, 1, structure. I will only consider conservative breaks of structure on the 4-hour chart as valid. 2, trading zones. I will only trade extreme zones that have led to a break of structure. 3, entry condition. I will always wait for a 15-minute change of structure for confirmation. 4, risk management. I will only risk 1% of my account on any single trade, and my reward to risk ratio must be at least 3-to-1. Writing this document forces you to adhere to a disciplined system and prevents emotional, impulsive decisions in the market. This document is your masterpiece.
In our journey of building a strategy, we learn to identify supply and demand zones. But a professional trader takes this a step further. They aren't just looking for a good zone, they are hunting for an exceptional one. What are the characteristics of an exceptional zone? Imagine a demand zone that not only caused a break of a major high, but just before doing so, it cleverly swept the liquidity resting below a previous low. This is no longer an ordinary zone. This is a very powerful area that shows the footprints of the big players. The art of personalizing your strategy lies in learning to recognize these details and subtleties, and to define stricter filtering rules for your trading zone so that you only engage with the best and highest probability opportunities.
I want to tell you an analogy that you should frame and etch into your mind forever. Imagine you are a hunter, abandoned in a large unknown jungle, the market. Your survival depends on your hunt, and for the entire day, you have only 2 bullets in your rifle. If you waste these 2 bullets, you will have no more chances to survive. Now in this jungle, you see rabbits, small birds, and large deer. Is it logical for you to fire your first precious bullet to hunt a small bird? Absolutely not. You wait with all your being, you conserve your energy, and you focus all your concentration on hunting a large, valuable deer in the best possible position. Trading is exactly this. We are not supposed to trade every small opportunity. We must wait for those golden, valuable setups.
Now let's apply this analogy to a real market scenario. You open the chart and you see 3 or 4 different demand zones lined up one after another. An amateur trader tries to place buy orders on all of them, hoping one will work out. But you as a professional hunter know that you only have 2 bullets. So you begin to filter. You look at the first zone and say, no, there's a large unfilled imbalance right below this zone. The price is likely to be drawn down there first to fill it. So this is not my bullet. You look at the second zone and say, this one is better. But the third zone also swept liquidity, which makes it look even stronger. You decide to save your 2 bullets for only the 2 zones that you believe have the highest probability of success, and you calmly ignore the rest of the opportunities.
You might ask, how do I know which type of zones have a higher probability of success? The answer is in one word: statistics. You are not supposed to guess. You are supposed to experiment like a scientist. You must get a notebook or an Excel file and record all your trades with details. This is the process of journaling. You go back into the market's history and find 100 trades based on zone type A, e.g. normal zones, and record the results. Then you find 100 trades based on zone type B, e.g. zones that swept liquidity. At the end, you will have reliable statistics. For example, you find out that type A zones were successful 60% of the time, but type B zones were successful 70% of the time. This statistic gives you an ironclad confidence to only risk your capital on type B zones from now on, because the data has proven to you that they are more profitable.
So far, we have talked about the mindset of a precise and patient hunter. But is this the only way to succeed? No. There's another type of trader in the market, the scalper. If our previous hunter was a sniper with 2 bullets, the scalper is like a soldier with a machine gun and hundreds of small bullets. A scalper strategy might be, I want to trade every valid zone and take a small, quick profit from each one. This approach is also completely valid and respectable. But this trading style requires a completely different kind of discipline. If you are going to take dozens of trades a day, you can no longer risk 1% on each trade, because 2 consecutive losses would mean your trading day is over. This style requires a very strong brake pedal.
This powerful brake pedal is the daily loss limit rule. This is one of the most vital concepts for any active high-frequency trader. Before the trading day begins, you must set a red line for yourself. You ask yourself, what is the maximum amount I am allowed to lose today? For example, you decide your daily loss limit is 2% of your total account. Now, based on your strategy, you estimate that on a normal day, you might take about 10 trades. Now, with simple math, you determine the risk for each trade. 2% daily loss limit divided by 10 number of trades equals 0.2% risk per trade. With this rule, you ensure that even if you have a bad day and all 10 of your trades close at a loss, you have only lost 2% of your account and can return to the market with strength tomorrow. In the end, all of these discussions come down to a personal choice. There is no absolute right or wrong way to trade in the market. There are 2 main paths before you. The path of the precise sniper, where you wait
with great patience and meticulousness for the best and highest quality opportunities and enter with a larger size. The second path is that of the fast machine gunner, where you trade many more opportunities with a very small size and a strict daily loss limit. Your final task in building your personal strategy is to be honest with yourself, and through testing and journaling, discover which of these two personalities is closer to your psychology and lifestyle. Building a strategy isn't about finding the right answers, it's about asking yourself the right question.
Let's put ourselves in the shoes of a scalper for a moment. Someone who loves the market's excitement and wants to profit from even the smallest fluctuations. This is a completely valid trading style, but it requires an ironclad discipline in risk management. Let's assume as a scalper you've decided that your daily loss limit is 2% of your total account. You also estimate, based on your own testing, that you might take around 10 trades on an active day. Now, with simple math, your risk per trade is determined. 2%, your daily limit, divided by 10, your number of trades, means you are only allowed to risk 0.2% of your capital on any single trade. With this method, even if you have the worst day imaginable and all 10 of your trades close at a loss, at the end of the day, you have only lost 2% of your account and can return tomorrow with a strong mindset. This mechanical risk control is a scalper's protective shield.
Now let's get to one of the most personal parts of a strategy, the entry trigger. You must define for yourself exactly what signal you need to see to enter a trade. One of the most popular methods is using candlestick confirmation. In this method, you wait for the price to reach your supply or demand zone, and then within that zone, you look for a powerful candlestick pattern that indicates a shift in power between buyers and sellers. For example, you might wait to see a beautiful pin bar with a long, elegant wick, which shows a decisive rejection of a certain price level. Or perhaps you'll wait for an engulfing pattern where a powerful bullish candle completely swallows the previous bearish candle. These candlestick patterns, like a form of body language, tell us that power is shifting and give us the green light to enter the trade.
Another method for getting confirmation, one that requires more patience but offers higher validity, is using structural confirmation. In this method, we no longer rely on a single candle. We wait for the market itself, with its structure and movements, to confirm our analysis. The scenario is as follows. The price enters our higher time frame demand zone. We do not immediately buy. Instead, we go down to a lower time frame, like the 1 minute or 5 minute, and we wait. We wait for the short-term downtrend on that lower time frame to break in our favor, creating a change of character. After this break, we enter the trade on the pullback to the new small demand zone that was created on that lower time frame. This method gives us greater assurance that the forces of the higher time frame are beginning to take effect on the smaller time frames.
And now for the third method, which is reserved for very patient and conservative traders who are only looking for the absolute best possible price. This method can be called the entry at a discount, or entry at 50% of the zone rule. In this strategy, you identify a very valid supply or demand zone, but you do not enter the trade as soon as the price touches the edge of the zone. You define a rule for yourself. I will only enter a trade if the price pulls back to at least 50% of the depth of my zone. What is the advantage of this? It gives you a better entry point, and therefore a smaller stop loss and a larger potential reward. But what is its great challenge? The psychological challenge. You must have the mental fortitude to watch the price, time and time again, just touch the edge of your zone and run away without you, and still not deviate from your strategy. This method is for the most disciplined of traders.
Now that we are familiar with different confirmation methods, a professional trader can combine them to create a very powerful, multi-layered entry system. This is the pinnacle of precision and meticulousness in trading. Imagine you establish such a rule for yourself. First, I will wait for the price to reach 50% of my demand zone. This is my first filter layer. Then, after reaching this point, I will wait for a structural confirmation on a lower time frame. This is my second filter layer. And finally, after the break of structure, to enter on the new zone, I will wait for a strong candlestick confirmation like a pin bar. This is my third filter layer. Will the number of your trades drastically decrease with this method? Yes, but the trades that pass through these three strict filters will, with near certainty, be the highest quality and highest probability trades possible.
On this journey, I want to warn you of a very dangerous trap. The trap of dogma and blind worship. You should have no dogmatic attachment to any person, style, or specific strategy, not even the strategies I am telling you about. Many of the great masters of the world, alongside their technical knowledge, have an intuitive feel for the market that comes from thousands of hours of screen time. They sometimes take a trade based on this intuitive feeling that they might not even be able to explain well. This is why you might follow a master's rules perfectly, yet not get the same results, because you don't have their intuitive feel and their thousands of hours of experience. So do not blindly copy anyone. Instead, try to understand the logic behind their actions and personalize it for yourself.
In the end, we arrive at the most important truth in the world of trading. On this path, we become familiar with various tools: market structure, supply and demand, pivots, moving averages, MACD, and so on. The ultimate goal is not for you to use all of them. The ultimate goal is for you to find those few tools that you are more comfortable with, that you understand better, and whose signals you see more clearly on the chart. Perhaps your entire strategy is built on just two simple moving averages and an RSI indicator. If you deeply understand this simple system, have tested it thousands of times, and have achieved consistent profit with it, then your strategy is the best strategy in the world, even if it bears no resemblance to the complex strategies of others. Success in this market is not found in an external system. It is built in an internal system that is an honest reflection of your own personality.
In this section, I want to share a very important and liberating mindset with you. We must not have any dogmatic or blind attachment to any specific analytical style. Our ultimate goal is to profit from the market, not to prove the superiority of one method over another. Perhaps someone, instead of using a smart money style break of structure, prefers to identify the trend using two simple moving averages. For example, they might say,
say, as long as my 50-period moving average is above my 200-period, my trend is bullish and I will only look for buys. Is this method wrong? Absolutely not. If this person has tested this system thousands of times and has achieved consistent profit with it, their system is the best system in the world for them. We must have the intellectual freedom to use whatever tool works best for us.
Now that we've freed our minds from dogma, how can we use classic indicators like Bollinger Bands, RSI, or MACD alongside our price action analysis? The key phrase is this: indicators should play the role of a second confirmation or an assistant for us, not a boss that gives us entry commands. The wrong way is to say, because the RSI is in the oversold area, therefore I will buy. The professional way is to say, the price has reached my very valid demand zone, and on top of that, the RSI indicator is showing a positive divergence, and on top of that, the price is also at the lower Bollinger Band. In this case, we have used the indicators to get more confirmations and to increase the probability of our trade's success, not as the primary entry signal itself.
A very conservative and professional trader can build a trading system with an extremely high win rate by stacking several layers of confirmation on top of each other. Let's imagine a dream scenario together. You've identified a very powerful demand zone. Your first rule is, I will only enter if the price reaches 50% of this zone. The price reaches the 50% level. Now your second rule activates, I must see a break of structure on a lower time frame. That happens too. Now rule 3, on the new zone that is created after the break of structure, I must see a strong candlestick confirmation like an engulfing pattern. That also happens. And finally, rule 4, during all this, I must also see a positive divergence on the RSI. Will the number of trades that pass these 4 strict filters be very low? Yes, but those trades that do will be like rare diamonds, the most valuable and highest probability opportunities in the market.
What is the most important part of this entire journey? It's that you adhere to your personalized strategy. But where does this adherence come from? From faith. And where does faith in trading come from? From statistics and data. You cannot stick to a strategy that only looks good in theory during a losing streak. You can only trust your system with your eyes closed when you have tested it hundreds of times on historical market data, backtesting, and have seen with your own eyes that, for example, this strategy has been successful 60% of the time in the long run and gives you a positive expectancy. These statistics are the bedrock and backbone of your discipline. This data gives you the mental fortitude to take the third trade without a hint of hesitation after 2 consecutive losses, because you know the final outcome will be in your favor.
Another one of the most important aspects of personalizing a strategy is choosing your primary time frame for trading. There's a general rule: the higher the time frame, the stronger and more valid its zones and trends are. A 4-hour zone has far more power than a 15-minute zone and can create a much larger move. Now you have to choose. Are you a patient person who, using the 2 bullets in the jungle analogy, is willing to wait for days for the price to reach your 4-hour or daily zone to take that one golden shot? Or are you a more active person who prefers to have more trading opportunities on lower time frames? Neither of these is superior to the other. What's important is that you choose a time frame that is in harmony with your personality and lifestyle. Let's address one of the most painful but common scenarios in the market, the stop hunt. Imagine you've done a flawless analysis, entered a buy trade at a demand zone, and placed your stop loss a few pips below that zone. The price, with a quick and vicious move, comes down with a long wick, activates your stop loss, and then with power moves in your intended direction without you. An amateur trader at this moment gets angry, curses the market, and tries to take revenge. But a professional trader calmly looks at the chart and asks themselves, is my initial analysis still valid? Has my zone been completely invalidated, or was this just a liquidity grab? If their analysis is still intact and the market gives them a new confirmation signal, they, without any emotional baggage from the previous trade, bravely re-enter the same trade.
And it's one of what they will see it, where are going to be there is what I want to do in the end. So this entire journey of building and personalizing a strategy culminates in the creation of a unique work of art that, like your fingerprint, belongs only to you. You choose from all the available options. What is your method for identifying structure? What are your criteria for a valid zone? What confirmation or confirmations will you use for entry? Do you get help from indicators as an assistant? What is your primary time frame? The final combination of these choices creates your strategy. Remember, the ultimate goal is not for you to trade like me or any other teacher. The goal is for you to know yourself and to design a system that showcases the best version of you as a trader. This process of self-discovery is your most valuable asset on this endless journey.
First off, I want to extend a special thank you to every single one of you for accompanying me on this educational journey so far. Your commitment to learning is what makes this all worthwhile. As we summarize, let's start with the absolute foundation of everything we do, market structure. We learned that to understand any chart, we must first learn to read its story by identifying its highs and lows and recognizing when a true break of structure occurs. We then elevated this by adding the lens of multi-time frame analysis, understanding the crucial difference between the slow, powerful 4-hour trend and the faster, more nimble, lower time frame order flow. This dual perspective allows us to grasp both the market's long-term intention and its short-term mood, preventing us from getting caught on the wrong side of the major players. This is the bedrock of our entire methodology.
Once we understand the market story, our next task is to identify the key locations where the next chapter of that story is likely to be written. We learn to distinguish between the two most important structural zones. The extreme zones, which are the origin points of entire market legs, and the decisional zones, which are the resting stops along the way. But we didn't stop there. We added a layer of objective mathematical precision by mastering pivot points. We saw how these 7 daily, weekly, and monthly lines act as a predetermined map of support and resistance that the big banks and institutions watch closely. The ultimate skill we learned was finding confluence, those magical spots on the chart where a structural zone, like an extreme, aligns perfectly with a major pivot level, like a weekly S1, creating a super level with an extremely high probability of reaction.
Finally, we elevated our thinking from that of a single trade trader to a portfolio risk manager. We learned the critical importance of understanding correlation and diversification. A professional knows that buying 2 highly correlated stocks or currency pairs isn't diversification,
It's a rookie mistake that multiplies risk. The ultimate goal is to build a complete, repeatable process, from mastering your platform to reading market structure, to identifying key confluence zones, to executing with a flawless risk management checklist, and finally to understanding how all your positions interact with each other. This is the path to consistency. I truly hope this journey has been valuable for you. Thank you for your time, your attention, and your dedication. I wish you all the very best on your trading path.
Our summary begins with the absolute foundation of professional trading, building a clear analytical blueprint. We established that the first step is mastering market structure, which means learning to read the market's story through its highs and lows and understanding the critical difference between the long-term trend and the short-term order flow. We then added a powerful objective layer to our analysis by mastering pivot points. We learned how the 7 lines of the daily, weekly, and monthly pivots act as a predetermined roadmap that the market's largest players watch closely. The pinnacle of this analytical stage was learning the art of confluence, the technique of layering these different maps, daily and weekly pivots, on top of each other to find super levels, those magical spots where multiple support or resistance levels align, creating zones of extremely high probability for a market reaction. Where are the key battlegrounds on the map?
Once we've identified our high probability zones, we don't just jump in blindly. The second stage of our process is about applying a series of precise filters to confirm our trade idea. We learned about the power of fractal confirmation using the alignment of the H4, H1, and M15 timeframes as a powerful tool to ensure the market's energy is flowing in our intended direction. Beyond that, we explored how to personalize our final entry trigger. We saw that a trader can choose to wait for a specific candlestick pattern, like a pin bar, a lower time frame break of structure, or even a deep pullback to the 50% level of the zone as their final green light. We even learned how to stack these confirmations on top of each other to create an ultra-high probability maximum security entry system. This filtering process answers the second crucial question: is now the right moment to act?
Knowing where and when to trade is useless without the discipline to manage risk. The third part of our summary focuses on the unshakable, non-negotiable pre-trade ritual that separates professionals from gamblers. This is a 3-step checklist. Step 1. We honestly and ruthlessly define our invalidation point, the price at which our trade idea is proven wrong, and calculate our risk in pips. Step 2. We identify a logical, evidence-based target for our trade based on market structure and calculate our potential reward in pips. Step 3. We act as the final emotionless gatekeeper, dividing our reward by our risk to ensure the reward-to-risk ratio is at least 3-to-1. If it isn't, we walk away, no matter how tempting the setup looks. This ritual answers the third question: is this trade worth the risk? And how do I protect myself?
The fourth stage of our education elevated our thinking from that of a trader focused on one setup to a risk manager focused on their entire portfolio. We delved into the critical concepts of correlation and diversification. We learned that buying 2 highly correlated assets like 2 major bank stocks or 2 currency pairs driven by the pound is a classic rookie mistake that doesn't spread risk but dangerously concentrates it. A true professional understands that their job is to build a balanced portfolio of uncorrelated assets to protect against sector-specific or currency-specific shocks. This strategic mindset also taught us to be wary of news events. Understanding that trading multiple pairs based on a single news release, like the NFP, is not smart trading but a concentrated gamble. This answers the fourth question: how does this one trade affect my overall exposure?
Finally, our journey culminated in the most important lesson of all: personalization. We learned that there is no single quote-unquote best way to trade. We contrasted the quote-unquote patient sniper approach, who uses their quote-unquote 2 bullets, to wait for days for one perfect A+ setup, with the high-frequency scalper approach, who uses a strict quote-unquote daily loss limit to take many small trades. We warned against the danger of blindly following gurus, as their success often comes from an unteachable intuition built over thousands of hours. The ultimate truth is that success comes from a deep process of self-discovery. Through rigorous backtesting and journaling, you must find the unique combination of tools, timeframes, and rules that resonates with your personality. The final strategy you build will be your unique fingerprint in the market, an authentic reflection of who you are as a trader. This answers the final and most important question: who am I?
Let's start with a familiar scene. You've spent hours practicing, you've done a flawless analysis, the price has reached your golden zone, and all the conditions are perfect for an excellent trade. But you are just staring at the screen. Your finger is hovering over the mouse button, your heart is pounding, and your mind is filled with doubt and hesitation. Should I enter now? What if it's too early? What if it's too late? This moment of entry is the moment all your theoretical analysis turns into real, tangible risk. This is the point of maximum psychological pressure in trading, and it's exactly here that many traders fail. They either never enter out of fear, jump in too early out of greed, or act too late out of regret. The goal of this lesson is to eliminate this fear and hesitation forever and replace it with a clear mechanical set of rules for pulling the trigger.
The first and most aggressive entry style is the risk entry, or limit order entry. This style is for traders who have absolute faith in their analysis and in the power of the zone they have identified. The philosophy of this trader is, my analysis shows that this is the exact point where the market should turn. I don't need any additional confirmation. They set their order at the edge of the zone before the price even arrives and have complete trust in their system. What is the great advantage of this method? You get the best possible price, your stop loss will be very small, and as a result, your potential profit reward increases dramatically. But what is its weakness? It is an entry based on a leap of faith. You enter without seeing any sign of the price turning, which might lower your win rate, because sometimes the market will power through your zone with force.
The second entry style is a more balanced and popular approach, the candlestick confirmation entry. This method is for the trader who trusts their zone, but before sending their entire capital into battle, waits for a quote, small sign of strength from their teammates. Their philosophy is, I'm in the right area, but I want to see the first spark of power before I join the fight. They wait for the price to reach their zone, and right there, they look for a powerful candlestick pattern like a pin bar with a long, beautiful wick, which shows a decisive rejection, or an engulfing candle, which shows the complete dominance of one side over the other. This candle is their signal and their entry trigger. The advantage of this method is a higher win rate compared to the risk entry. The downside?
Your entry price might be slightly worse, and sometimes the market reverses so quickly that it doesn't give you the chance to form a clean candle pattern.
And now for the third entry style, which belongs to the most conservative, patient, and perhaps most disciplined traders, the structural confirmation entry. The philosophy of this trader is, I don't trust my zone alone, and I don't trust a single candle. I will wait for the market itself to confirm my analysis with the language of structure. I need irrefutable proof. They wait for the price to enter their higher time frame zone, then they go down to a lower time frame and patiently watch until the short-term trend on that time frame breaks in their favor. This change of character on the lower time frame serves as a definitive confirmation from the market for them, and only then do they enter the trade. The advantage of this method is the highest possible win rate. The major downside, you will get the worst entry price and you will miss many of the fast and large market moves that occur without forming a clean break of structure on the lower time frames.
In the end, these three entry models can be compared to three different types of warriors. The risk entry is like a special forces operative who, alone and with high risk, strikes the first blow deep in the heart of the enemy. The candlestick confirmation entry is like an infantry soldier who waits for the first shots to be fired and the battle to begin before engaging. The structural confirmation entry is like an armored tank commander who waits for the enemy's front line to be completely broken before rolling in with full force and high security. None of these three styles is absolutely superior to the others. The best style for you is the one that is in harmony with your personality, your risk tolerance, and your level of patience. The goal of this lesson is for you to get to know the advantages and disadvantages of each so that you can consciously choose your favorite weapon for entering the battlefield.
Today we are going to add several powerful weapons to our trading arsenal for entering the market. We will become familiar with various entry methods based on a change of character, entries based on a flip zone, entries using inducement liquidity, and various types of continuation entries. Seeing this long list, the mind of a novice trader gets excited and thinks, great, I'll learn all of these and use one of them in every situation. But I am here to give you a serious warning. This way of thinking is a direct path to failure and confusion. A professional trader is not a collector of tools, they are a master craftsman who uses only one or two of their favorite tools with the utmost skill. The goal of this lesson is not to collect tools, it is to find that one or two tools that were made for you.
So if we're not supposed to use all of these methods, how are we supposed to find the one or two that are right for us? The answer lies in a scientific and honest process, testing and journaling. You cannot make a decision based on a gut feeling. You must, like a scientist, take each of these entry models, go to the historical market data, and test it on hundreds of different trades. Backtesting. You must create a detailed trading journal for yourself and record all the results. What was the win rate of each model? What was its average reward to risk ratio? And most importantly, how did you feel when you were using that model? Were you comfortable with it, or did it make you anxious? At the end of this time-consuming but essential process, it is the data that will tell you which entry method is most in harmony with your personality and psychology and brings you the highest positive expectancy.
Before we get to our first entry model,
we must etch the most important rule and prerequisite for any type of confirmation entry into our minds. This rule states, any entry signal on a lower time frame is only valid if the price has first reached a valid supply or demand zone on a higher time frame. What does this mean? It means if you see a beautiful change of character or a break of structure on the 1 minute time frame, but this event occurs in the middle of nowhere and far from any significant zone, that signal is most likely a trap and worthless noise. We pay no attention to these fake signals. A change of character on a lower time frame only becomes meaningful to us when it occurs as a reaction to a higher time frame zone, e.g. a 15-minute or 1-hour zone. This means the power of the big players is starting to affect the smaller players.
All right, let's examine the first entry model based on a change of character, CHOCH. This method is the most classic and perhaps the most logical entry style. The scenario is as follows. 1, the price hits our higher time frame supply zone. 2, we go down to the 1 minute time frame and wait for a break of structure or a CHOCH to the downside. 3, this break of structure creates a new small supply zone on that same 1 minute time frame, which we call the origin zone. 4, our strategy in this model is to patiently wait for the price to make a pullback to this new origin zone. We set our sell limit order on this small zone, place our stop loss just above it, and anticipate a new bearish move. This method is known as the return to origin entry.
Before we move on to the next entry model, let's answer the question, once we're in a trade, where should we get out? There are several different approaches to setting a target or take profit. Approach 1 is structural targeting. You look at the first valid demand zone in the path of the price and consider it your final target. Approach 2 is liquidity-based targeting. You identify an important liquidity pool, like a clear double bottom, and expect the price to move towards that level to hunt that liquidity. Approach 3 is mathematical targeting. You define a fixed reward to risk ratio for yourself, for example 4-to-1. As soon as the price has moved 4 times your risk in the direction of your analysis, you exit the trade without regard to the structure. Each of these methods has its own fans. The second entry model, based on a change of character, is designed to solve a common problem. Sometimes, after a CHOCH, the move is so powerful and fast that the price never pulls back to the origin zone and we miss the trade. To solve this issue, we can use the entry at 50% method. In this model, after the CHOCH occurs, we consider the entire new bearish leg or wave that has been created. Then, instead of waiting for the price to return to the supply zone at the highest point, we place our sell order at the 50% Fibonacci level of that wave. What is the advantage of this method? The probability of us getting into the trade becomes much higher. What is the disadvantage? Our stop loss will be wider compared to the first method, and as a result, our reward will be slightly reduced. This is a trade-off between precision and the certainty of entering a trade.
In the end, we have now reviewed 2 different entry models, the precise and low risk return to origin model and the faster but higher risk entry at 50% model. Neither of these 2 methods is absolutely superior to the other. One trader might be more comfortable with the small stop loss and lower win rate of the first method, while another trader finds the psychological pain of missing a trade so great that they prefer to work with the larger stop loss but higher entry probability of the second method.
Your job is to test both of these models extensively on historical market data and see which one is more compatible with your psychology, personality, and risk tolerance. This choice is one of the most personal and important decisions you will make in building your trading strategy.
In the previous section, we were faced with a classic trader's dilemma. Do we take the precise return to origin entry and risk missing the move? Or do we take the 50% pullback entry with a larger stop? The third entry model offers a clever solution to this problem, a hybrid approach we can call the split entry. In this method, instead of putting all your risk on one entry point, you divide it into two parts. Let's say your maximum allowed risk for this trade is 0.5% of your account. You take half of that risk, 0.25%, and enter aggressively right after the break of structure. You then take the other half of your risk, the remaining 0.25%, and place it as a limit order at the origin zone, the extreme point of the move. With this method, you have covered both scenarios.
This hybrid entry method provides a huge psychological and strategic advantage. Let's review the possible outcomes. Scenario 1. The price, after breaking structure, never pulls back to the origin zone and moves away quickly. In this case, you are in the trade with your first position and haven't missed the move. Scenario 2. The price after breaking makes a deep pullback to the origin zone. In this case, not only is your first position active, but your second position also gets filled at the best possible price, and you are in the trade with your full intended size. Scenario 3, the loss. The price completely reverses and activates both of your stop losses. What happens in this case? You have lost a total of exactly 0.5%, the amount you were willing to risk from the very beginning. This method allows you to have the chance for a quick entry and a precision entry without increasing your total risk.
Now we're going to move on to a very beautiful and conceptual entry model called the flip. To understand this concept, imagine a story. The price is approaching a higher time frame supply zone. But before it gets there and breaks the structure, it reacts to the last line of defense for the buyers, a small demand zone. The buyers in this zone try their best and push the price up a little, but their strength is not enough to make a new high. Then the sellers return with full force and not only break this line of defense, the demand zone, but also break the main low, creating a change of character. That demand zone that failed to defend the price has now become a very important area. This zone has been flipped, and from a demand zone, it is turned into a very sensitive supply zone.
Now that we have identified this important flip zone, should we immediately place a sell order on it? Here lies a very professional tip that can drastically increase your win rate. The best and safest way to trade a flip zone is to wait for the price to build a little liquidity below it before returning to it. What does this mean? It means the price creates one or more small nearby highs just before it reaches the flip zone. These highs, like a trap, tempt impatient traders to sell prematurely. Then the market, with a quick move upwards, activates the stop losses of these sellers, collecting the liquidity, and then reaches our main flip zone, from where it begins its primary bearish move. So our golden rule is wait for the liquidity to be built and then enter your trade on the flip zone.
Let's address one of the most painful feelings a trader can experience: missing out on a perfect trade. You've done a flawless analysis, you've identified the entry zone precisely, but for whatever reason, you were asleep, you were out, or you hesitated, you weren't able to enter the trade, and now the price has begun its main move and is getting further away from you. The question that eats at your mind in this moment is it all over? Have I lost this opportunity forever? The answer is maybe not. There's a concept called continuation entries, which allows us to join a trend that has already begun. But this has a very, very important rule that, if not followed, will lead to heavy losses.
The main rule for continuation entry is this: you are only allowed to enter in the middle of a trend if the price has not yet reached a major opposing zone on a higher time frame. If the price has already reached the opposing zone, it means the energy of that trend is likely exhausted, and entering late at that moment is like jumping in front of a braking train. But if there is still a lot of room to go before the opposing zone, you can enter the trade on the pullbacks to the small supplier demand zones that are created on the lower time frame along the way. Here too, the same golden rule from flip zones applies. The best and safest continuation entries are those where a local pool of liquidity has first been created near your zone before the price reaches it.
In continuing our discussion on continuation entries, we're now going to address a very professional, albeit slightly cynical, technique. Let's say you've missed the initial entry into a new trend. The price has moved on and created a new supply or demand zone along its path. An impulsive trader would immediately place an order on this new zone. But an experienced trader often considers this first continuation zone to be a fake zone or a decoy. They patiently allow the price to break through this first zone and watch it fail. Then they wait for the second continuation zone to form and prepare themselves to enter there. Even then, the best case scenario is for a small pool of liquidity to be built near that second zone before the price reaches it. This cynical perspective and this patience to wait for the second zone drastically reduces the risk of continuation entries.
Now we will learn about one of the most common and intelligent traps that market makers use to ensnare retail traders: the concept of inducement, IDM. Picture the scenario. The market is in an uptrend and is currently in a pullback. You see two very clear demand zones, one after the other. The price moves downwards with speed and momentum and smashes right through the first, higher demand zone. What happens at this moment? Thousands of traders, upon seeing this break, are induced into thinking the uptrend is over and they start selling. They have, in fact, fallen into the trap, because the main goal of the market makers was to bring the price to the second, lower and stronger demand zone, and breaking the first zone was merely to collect the liquidity of the sellers and get them on the wrong side of the market.
A professional trader, upon seeing the scenario of two consecutive zones, always looks at the first zone with a healthy dose of skepticism. They often consider it to be quote-unquote bait and simply ignore it, focusing all their attention on the second, more significant zone. A very important clue to distinguish whether the break of the first zone is real or just an inducement is the quote speed of the price movement. If the price drifts down slowly and weakly towards the first zone, it will likely react to it. But if the price attacks the first zone with powerful candles and high momentum, it is almost certainly an inducement, and the price is going to break it to reach the second zone. So by understanding this concept, not only do we not fall into the trap, but we use it as a confirmation for a stronger entry at the second zone.
Now, we arrive at a completely different entry model that isn't based on zones, but on a specific candle action.
the liquidity sweep entry. In this strategy, we wait for the market to perform what we call a stop hunt. Our signal is a powerful candle that, with its long wick or shadow, stabs through a previous major high or low to trigger all the stop-loss orders accumulated there. But then, its body pulls back aggressively into the previous range and closes there. That long wick, like a vacuum cleaner, has swept up all the liquidity, and now the market is ready for a major move in the opposite direction. For this signal to have high validity, that wick needs to be large and significant. For example, at least the size of the candle's own body.
When using the liquidity sweep entry strategy, there is a golden and very important rule. We are only permitted to take trades that are in the, quote, direction of our main trend. What does this mean? Let's say we are in an overall uptrend. In this case, if the price performs a liquidity sweep at the high of a major range, which is a bearish signal, we pay no attention to that signal and ignore it. Why? Because this move is against our main trend and is likely just a more complex correction. However, if in this same uptrend the price performs a liquidity sweep at the low of a major range, which is a bullish signal, this is the best and most valid signal for us. This means the market, after refueling, is ready to continue its main journey upwards.
Now that we have observed the liquidity sweep signal on our main time frame, e.g. 15-minute, how can we enter the trade with the utmost precision? Here lies a very advanced technique. After our 15-minute candle with that long wick is closed, we do not immediately enter the trade. Like a surgeon, we go down to the 1-minute time frame and microscopically we examine the price action inside that same wick. We wait until on the 1-minute time frame a small change of character or break of structure occurs in our favor. This tiny break is our final and definitive confirmation that the control of the market is truly shifting. We then enter the trade on the small zone that is created on that 1-minute chart. This method gives us a very precise entry point with a very small stop loss.
On this journey, we have equipped our trading arsenal in the most complete way possible. From the classic entries based on a change of character, both the return to origin and the 50% pullback methods, to the beautiful and conceptual entries based on flip zones, we then learned how, even when we've missed a trade, we can safely join the trend using continuation entries. We became familiar with market traps like inducement, and learned how to use them to our advantage. And finally, we became acquainted with one of the most advanced methods, the entry based on a liquidity sweep. You now have a complete set of various weapons at your disposal
Your job is to, with practice and testing, find that one weapon that in your hands works in the best and most lethal way possible.
And now, the final and most important stage of this journey begins. Your ultimate task is to take these different entry models and test them extensively in the historical market data. You must, for each model, gather accurate statistics on its win rate for you. Perhaps after testing, you discover that the quote flip zone model gives you an 80% win rate, while the quote change of character model gives you a 70% win rate. This data helps you to consciously decide which model is your statistical quote edge in the market. Once you have made this choice, you will write it down in your strategy document as your primary entry method. From that moment on, you will acquire the most important skill of a professional trader, the power to say no. You will learn to say no to all other setups, no matter how tempting they may seem, because they are not part of your tested strategy. The market can go wherever it wants. That is no longer your concern.
As we conclude our discussion on the liquidity sweep entry, I want to share one final, critical rule that will save you from a common trap. When the price performs a liquidity hunt below a low with a long wick and then reverses upwards, we expect that low to now be protected. The logic is that the major players who engineered the sweep have taken control and are ready to push the price higher. Now, if the price comes back down and, for a second time, sweeps the liquidity of that same low, the entire bullish setup is immediately null and void. We are no longer permitted to look for a buy entry in that area. A successful hunt is done with a single, decisive strike. A second strike at the same point shows a lack of commitment from the buyers and a persistent strength from the sellers. When you see this, you must discard the setup and wait for a completely new opportunity to form.
First off, I want to extend a special thank you to every single one of you for accompanying me on this educational journey so far. Your commitment to learning is what makes this all worthwhile. As we summarize, let's start with the absolute foundation of everything we do, market structure. We learned that to understand any chart, we must first learn to read its story by identifying its highs and lows and recognizing when a true break of structure occurs. We then elevated this by adding the lens of multi-time frame analysis, understanding the crucial difference between the slow, powerful 4-hour trend and the faster, more nimble, lower time frame order flow. This dual perspective allows us to grasp both the market's long-term intention and its short-term mood, preventing us from getting caught on the wrong side of the major players. This is the bedrock of our entire methodology.
Once we understand the market story, our next task is to identify the key locations where the next chapter of that story is likely to be written. We learn to distinguish between the two most important structural zones, the extreme zones, which are the origin points of entire market legs, and the decisional zones, which are the resting stops along the way. But we didn't stop there. We added a layer of objective mathematical precision by mastering pivot points. We saw how these 7 daily, weekly, and monthly lines act as a predetermined map of support and resistance that the big banks and institutions watch closely. The ultimate skill we learned was finding confluence, those magical spots on the chart where a structural zone like an extreme aligns perfectly with a major pivot level like a weekly S1, creating a super level with an extremely high probability of reaction.
Knowing what the market is doing and where to trade is only half the battle. The other half, the part that truly separates professionals from amateurs, is how we execute. We built a non-negotiable, mechanical, pre-trade checklist. Step 1, we honestly define our invalidation point and calculate our risk in pips. Step 2, we identify a logical, structure-based target and calculate our potential reward in pips. Step 3, we act as the final gatekeeper, ensuring the reward to risk ratio is at least 3-to-1 before we even consider placing a trade. On top of this, we use fractal confirmation, the alignment of the H4, H1, and M15 timeframes as our ultimate filter at our high probability zone before we pull the trigger. This entire process removes emotion and ensures we only take disciplined, high-value trades.
Finally, we elevated our thinking from that of a single trade trader to a portfolio risk manager. We learned the critical importance of understanding correlation and diversification. A professional knows that buying two highly correlated stocks or currency pairs isn't diversification. It's a rookie mistake that multiplies risk. The ultimate goal is to build a complete, repeatable process, from mastering your platform, to reading market structure, to identifying key confluence zones, to executing with a flawless risk management checklist, and finally to understanding how all your positions interact with each other. This is the path to consistency.
I truly hope this journey has been valuable for you. Thank you for your time, your attention, and your dedication. I wish you all the very best on your trading path.
Stay disciplined, stay curious, and be well. Goodbye.